Welcome to the Chapter 15 video on integration. Moving on to the next slide, what is integration? The textbook talks about perfect integration. And what perfect integration is that the taxes paid if an individual decides to operate as a sole proprietorship should equal the same amount of taxes paid if that individual decides to incorporate their business, pay the corporate tax, and then using the after-tax proceeds pay themselves as a shareholder a dividend. And the total taxes paid in the corporate structure between the corporation and the individual shareholder should be exactly the same as if they decided to operate the business as a sole proprietorship. So perfect integration is basically saying that in a perfect world, if the tax rates were perfectly integrated, it should not make a difference from a tax perspective whether you operate your business as a sole proprietorship or if you decide to incorporate and then pay yourself a dividend with the after-tax corporate profits. Now, unfortunately in Canada, we do not have perfect integration. Before we get into some calculations, let's talk about why an individual might decide to incorporate versus operating as a sole proprietorship. So why would we incorporate? Well, there could be tax reduction. Remember we said that we don't have perfect integration in Canada, so it's possible that if the individual decides to incorporate and operate their business through a corporation, they could end up paying lower combined corporate and individual taxes versus if they operated as a sole proprietorship. Now that's not always the case, but possibly that could be a reason why they might want to incorporate. Next, there could be tax deferral. Tax deferral says that if we incorporate, the corporation will pay the corporate tax, and if the corporation does not pay a dividend to the individual shareholders, there's a deferral on paying the individual tax. So there's basically some savings from tax deferral on not having to pay individual tax until the corporation decides to pay a dividend to the individual shareholder. Moving on, there could be what we call income splitting. What that means is that if they decide to incorporate the business and the corporation operates the business, they could hire family members to do work in the corporation and basically split the income that the corporation is earning. Also, there could be other considerations. With a corporation, there's limited liability. Also, the individual shareholder could access the lifetime capital gains deduction when the individual shareholder says they want to retire and sell the shares. And there's also some flexibility as well. The corporation could decide whether to pay the individual shareholder a salary in their capacity as an employee or pay them a dividend. So those are some of the reasons why we would want to incorporate. Moving on to the next slide, let's talk about disadvantages of incorporation. If the corporation has losses, those losses cannot be used personally. So if the individual decides not to incorporate and decides to operate as a sole proprietorship, and their sole proprietorship business has losses, those losses can be used to offset other income that they earned individually. With a corporation, if a corporation has losses, those losses can only be used by the corporation and cannot be used by the individual. Also, tax credits. Individuals get tax credits, whereas corporations do not. And one of the examples is charitable donations. If, let's say we have an individual, they decide to incorporate, and the corporation makes a charitable donation, that donation will only reduce their income. It will not be a tax credit, whereas individuals making a charitable donation will get a tax credit. And once we work through the calculation, that tax credit will reduce their tax liability dollar for dollar. So it might have a bigger impact on their individual tax return than if the corporation was to make a donation. Moving on, there's also the cost of maintaining a corporation. Corporations, there are fees that have to be paid to incorporate. There's also annual fees that must be paid. And also when the corporation decides to wind up, there would be additional cost as well. So those are some of the reasons why an individual may decide against incorporation. What we're going to do next then is work through assignment problem 15-2, and this is going to give us some examples of integration. So read through 15-2. This problem incorporates provincial taxes as well. So keep that in mind. And many of the examples we worked through in the earlier chapters, we only focused on federal taxes. But when it comes to integration, we have to bring in the provincial taxes. And so pause the video now. You'll see that there are 3 parts to this question. Just work through part A for now. So pause the video, read through assignment 15-2, work through part A, and once you've done part A, then resume the video. Okay, let's jump into part A on the next slide. Part A wants us to work through the calculations if the individual decides not to incorporate. So this is fairly straightforward. This is drawing from a lot of the calculations that we learned in our individual personal tax course. Now, there's 2 streams of income. There's the business income and also the eligible dividends. So let's take a look at the 2 amounts. The business income is $115,000. The eligible dividends are $133,000. So if this was earned individually, the individual will have to gross up the eligible dividends, and currently, as of 2019, the gross up is 38%, and so this would be their taxable income. Now, the question gives us their tax rate at 53%, 33% federally, 20% provincially, so the total tax rate is 53%, and this would be the total taxes payable. Now, the dividends get a dividend tax credit. The dividend tax credit is going to be the federal plus the provincial amounts times the gross up. Federal is 6/11. In the question, it says that eligible dividends in the province that this individual lives in gets a dividend tax credit of 40% of the gross up. So we're going to take 6/11 plus 0.4, multiply that by the gross up, and this would be this individual's dividend tax credit. So then what we have next then is the total personal tax payable. Now we add those up, and so the total tax payable by the individual would be $110,443. So that is part A of the question. Let's move on to the next slide, and let's look at part B. Now there's many parts that are asked in part B. Let's just do the first part. Now the individual is going to incorporate, and we're going to calculate what is the corporate tax payable on the active business income and also the dividends if it was received by the corporation. And then we want to figure out is after the corporation pays the tax, how much would be available to distribute to the shareholder. And we're going to assume that they're going to get the dividend refund back. And so let's pause the video now, work through this first part. What is the total corporate tax payable? Part 1, also part 4. Remember, part 4 tax relates to dividends received by the corporation. And then figure out how much after-tax proceeds would the corporation have to make a dividend distribution to the shareholder. So pause the video now. Okay, let's look at part B of the question. We're going to incorporate, and we're also going to have 2 streams of income, the business income and the dividend income. The business income, $115,000, the dividend income, $133,000. Let's figure out how much tax would have to be paid on the business income. So the business income is active business income, and this company is CCPC. So they're going to pay federal tax of 28% minus the small business deduction of 19%, and also as provided in the question, the provincial tax on active business income earned by a CCPC is 2%. So we multiply the $115,000 by this percentage, and that's the Part 1 tax on the business income. Now remember, the dividends are considered portfolio dividends, and so the corporation will have to pay Part 4 tax of 38 1/3% on these portfolio dividends. So then after tax, this would be the amount available for distribution as a dividend. However, we're going to assume that if the corporation pays a dividend to the shareholder, they're going to pay the maximum dividend possible to get back all of the refundable taxes. So that Part 4 tax of $50,983, they're going to add that to their eligible RDTOH account, because remember, these are eligible dividends, and we're going to assume that they're going to get all of that back. So if they get all of that back as a dividend refund, that's going to increase the amount that they can distribute as a dividend. So the total amount available for distribution as a dividend would be $133,000 as an eligible dividend. Remember, those dividends were classified as eligible dividends, so that amount would be added to the GRIP, whereas the $102,350, that was earned as active business income, and the corporation paid low rate corporate tax, so that would be added to the LRIP, the low rate income pool, and that amount would be distributed as a non-eligible dividend. So that is the first part of Part B. Let's move on to the next slide, and let's continue on with Part B. Now we're going to assume that the corporation pays the $102,350 non-eligible dividend and the $133,000 eligible dividend to the individual shareholder. So now calculate how much is the individual tax on the receipt of these two dividends by the individual shareholder. So pause the video now. Okay, let's resume with Part B. Now the individual shareholder receives these amounts of dividends. Let's focus on the eligible dividends and then the non-eligible dividends next. So the eligible dividends will be grossed up at 38%. The non-eligible dividends will be grossed up at 15%. So now we have the total taxable dividend. Now in the question, this individual is going to pay 53% individual tax. So now we have the total tax payable before the dividend tax credits. And then let's figure out the dividend tax credits. First, for the eligible dividend. Once again, 6/11 is the federal, 40% is the provincial as given in the question. And then we have the non-eligible, 9/11 federal, 23% provincial as given in the question. And then we have the total tax payable after the dividend tax credit. So that would be the total personal tax payable on the receipt of the dividend income by the individual shareholder. So let's move on to the next slide. Now we're going to go to Part C. Now Part C says, well, let's compare the results. Figure out the total tax payable in Part A versus the total tax payable in Part B. And then figure out what the dollar difference is between the two parts, and also see if you can explain why there is that difference. So pause the video now to finish Part C. Okay, let's continue on with Part C of the question. Now we're going to compare the results from Part A and Part B. Now remember, Part A was operating as a sole proprietorship, and we calculated the total tax payable was $110,443. Now for Part B, we have to add the total taxes paid by the corporation plus the total taxes paid by the individual. And the total tax payable, if we had a corporation, and this includes both the corporate tax and the individual tax, is $110,366. So what we see here is that if they operated without a corporation, they pay slightly more tax of $77. So we don't have perfect integration, but it's actually fairly close. I mean, $77 over $110,000 is, very, very minor. So there's a very, very minor difference. They would benefit slightly if they had a corporation. Now let's explain why. Let's actually look at the two streams of income. Let's first focus on the So let's focus first on the eligible dividends. So the eligible dividends, if it were received in Part A without a corporation, the individual would have paid $49,493. Now, if we look at the same eligible dividend stream with the corporation, remember the corporation pays Part 4 tax, but they get it all back. And then the individual would get the dividends of $133,000. So they would pay the same amount of individual tax regardless whether there's a corporation or not. So there's no difference in the eligible dividend amount. The $77 difference comes with the business income. So if we look at Part A without the corporation, the individual would pay $60,950. Now, looking at just that business income stream of $115,000 was earned through the corporation. The corporation paid the non-eligible dividend. The total tax paid with the corporation, looking at both the corporate and individual tax, was $60,873. So it was slightly lower if we had a corporation. Well, what's the reason for that? There's a couple reasons. The first is the corporate tax rate. Now, the corporate tax rate for the active business income was 11%. So remember we said that we started off with 28%, we minus the 19% small business deduction, we added the 2% provincial tax. That was only 11%. Now, for perfect integration, as the textbook mentions, the corporate tax rate should be about 13.04%. So this is slightly lower than what is required for perfect integration. So there's some corporate tax savings with the lower corporate rate. However, offsetting that is the provincial dividend tax credit. The provincial dividend tax credit for non-eligible dividends, as given in the question, is 23%. For perfect integration, we would need that percent to be 30.8% or 4/13. So what we see is that there's two items that impact this question. The corporate tax rate is lower than what's required for perfect integration. So that's going to make the corporate structure more attractive. However, offsetting that is that the provincial dividend tax credit for non-eligible dividend is lower than what's required for perfect integration. So when we look at the calculation above, we see that the difference between Part A and Part B is $77. And once again, that can be explained partly by the lower corporate tax rate on active business income and also the lower provincial dividend tax credit rate on non-eligible dividends. So that brings us to the end of this Chapter 15 video on integration. We'll see you in the next video, and good luck with your studies.